Okay, yeah, go ahead.
All right, sweet. So let's just start off with the agenda. Thank you guys so much for coming out here today, learning a little bit about what it's like to value, or rather, be in the position of a venture capital firm, and having this qualitative analysis of the startups that you're vetting for investment. So before we get started, we're just going to have a basic review of what venture capital is, private equity, what it's like. Then we're going to go straight into evaluating startups, investment thesis, what the reports are, what the deliverables are, and then we can get any questions out of the way. So let's just get started. What is venture capital? Venture capital is private equity financing that is provided by venture capital firms or funds to startups, early stage, and emerging companies that have been deemed to have high growth potential or which have demonstrated high growth in exchange for equity or ownership stake. So you guys already know, many people have gotten to know what venture capital is through Shark Tank. It's basically what happens in that TV show over the course of many months and sometimes years, and done for like a genuine business and not just media and entertainment. So yes, that's venture capital. And venture capital, as I said, it is a private equity type of deal. So unlike investing in stocks, you're investing in private companies that have not gone onto a stock market. And this has its pros and cons. One major thing that participants in the competition will realize is that you don't have these places of public information, such as the 10K, the 8K, so on and so forth, these publicly released financial statements.
Rahul,
For, uh,
I don't
yes.
mean to interrupt, but your volume keeps fading in and out.
Oh, uh, okay. I'm not sure why that is.
Um, is this better? All right. I'm just going to continue. And let me know if it happens again. All right. Thanks. So as I was saying before, as competitors are going to realize you don't have these 10Ks, these 8Ks, these sources of public financial statements to evaluate what the profitability or just generally like evaluate the startup off of. So you're going to have to rely on more or rather other details in order to judge these startups. And in many cases, a lot of these details are going to be qualitative. And I can go into that further. That's why we're doing this presentation, and that's why we have a lot of information today. But before we get into like actual frameworks, I want to talk a little about the actual mindset that goes into evaluating startups, private startups. First, oh, shoot, anyway. Right. First and foremost, product market fit. This is a word thrown around a lot in Silicon Valley, and essentially it means the degree to which a product satisfies a strong market demand. The primary goal from the perspective of a venture capital firm in evaluating a startup is understanding if they meet product market fit or not. And it's a very good measurement to see if a startup is going to be successful or not. If they have good product market fit, then it's highly likely that they're going to be successful in some way, shape, or form. And the second thing that I wanted to note was valuation oftentimes can feel like less of a science and more of an art. And while this is just like one of the first times that you'll be evaluating something, it's important to strike a balance between being very data driven and getting all the details, but also like understanding that there's an element of growth that you have to expect out of these startups. And it's in that area of growth where you can play around a little bit. But that still means like you need to be very smart about what you expect out of the startup, and the various things that I'll be talking about further on in this presentation will help you reach a very strong thesis when it comes to these startups that you're evaluating. So yes. First thing you should keep in mind for startups that you're evaluating for your venture capital firm is management. The actual people behind the startup are very important when it comes to evaluating the startup, because oftentimes it's all they have. So VCs would rather invest in a bad idea and good management than a great idea led by bad managers. And the basic thesis of this is because the management team is going to be executing the business plan. So how successful do you think they will be in executing the business plan? How much management experience do they have? What are their strategic goals and what are their qualifications? How knowledgeable are they of the industry, the competitors, potential acquirers, and product? And in the event that startups that you're looking at don't have a very strong management team, they should be looking for other managers or founders, people to bring onto the management team that can handle that technical responsibility or industry responsibility. Next thing is the size of the market. This is very big for venture capital firms because what you're looking for is very quick growth and very quick very quick growth can only be accomplished if there is that runway for growth and that potential. So startups must target large markets that can generate $1 billion or more in revenues. As I said, they must have the opportunity to grow their sales worth hundreds of millions of dollars. The larger the market size, the more likely the startup will be acquired or go public, which are two of the main ways venture capital firms make their money. Ideally, the startup will grow fast enough to take first or second place in terms of market acquisition, and investors should expect startups to include a detailed market analysis in their business plans. Of course, the information that you'll find online for startups that you're looking at in this competition might be not as detailed, but if you can find an idea of where they're planning on going and how large the market is, then that's a good detail to have when you're presenting these reports for the startups. Next thing is product and competitive edge. The product has to be sustainable and a long-lasting, long-term solution to a consumer problem. Basically, you don't want these companies making products that can be disposable or can be replaced by other companies. You want to build a moat around the products that these companies are making so that they'll be long-term investments and you'll see value coming out of them. So yes, customers have to need the product because it's cheaper or better than competitors. The fewer the direct competitors, the better. So you want there to be as little competition in the space as possible. And at least even if there is competition, then these investments, these startups that you're investing in have to be able to beat the other competitors in the space and have to have like a roadmap or a strategy to do so. Risk assessment. So of course, in all investments, there are going to be risks, and venture capital is no different. It's just in private equity in general, you want to make sure that the companies that you're investing in inherently don't have any legal issues or any other risks down the line that they might come into. So what legal issues could come up? Is the problem a problem that is addressable right now, or is it something that can only be addressed in the future? Does the fund have enough money to help the company achieve its goals? What potential exits does the startup have? How many larger companies would want to acquire it? Or would the founders be able to take the company public? And how exactly will the money be used? Of course, you want to make sure as a venture capital firm, is this a startup that we can help to the greatest extent? And does it align with our vision as a venture capital firm? So all these things, all these questions, very important when you're coming up with startups to look at or just how much to invest. Next, we have differentiability, and very similar to that competitive edge slide from before, but essentially you want to make sure that the product must differ from the other competitors in the space while also providing like a solution that others want. competing startups and larger companies must be unable to replicate the product. If not unable, then make it harder for them to replicate the product. And if the product is easily replicable, the startup will lose market share and experience lower sales. Startups usually choose to provide a cheaper alternative, create a better quality product, or innovate in a new way. So one of these three things are a general rule of thumb for startups to provide a strong and a good product. And last but not least, ability to scale. It goes hand in hand with growth, but oftentimes the growth is more of an external thing, whether the market is actually ready for it, whereas ability to scale is inherent to the startup itself. So is the startup being built in a fashion that makes it easily scalable? Oftentimes you find software being invested in by venture capital firms, mainly because of software's ability to scale exponentially and almost indefinitely. Yeah, so it's a lot easier to scale up a tech startup that is developing an app than a food startup that's developing a superfood. The tech startup will rely heavily on its developers, while the food startup has a lot more, many more resources that they're going to need in order to progress and move on to the next stage, get more revenue, profits, etc. All right, so that's all the main things that you guys should be keeping in your mind. I'll go over it at the end of this qualitative analysis section. But yes, those are all main things that are vital to understanding the various startups that you'll be looking at. Now we'll be taking a look at valuation frameworks and other frameworks to analyze your startups deeper in a more detailed fashion. Okay. First method of evaluating startups is the Berkus method. Basically, you take a look at 5 different aspects. Some of them were taken from, some of them are similar to the ones that we reviewed already. First, you have sound idea. So what is the idea? You can take a look at product market fit here. Prototype, management team, strategic relationships, and the sales or revenue generated already. So as an example, to help you guys understand this a little bit more, I took a startup branch. They're building what they're calling like the next level of Zoom. So interactive and almost game-like communication on the internet. So first off, taking a look at what the idea is, it's an amazing idea. So you can give them a full $500,000. Their prototype, recently they launched a beta version that has been getting a lot of good hype. So throw another 400,000 into there. Their management team, they're on the younger side. They don't have as many partnerships. Their networks are not as strongly developed. They also don't have prior business acumen or experience. One of their founding team is in high school. So 200,000 towards that. Next, we have strategic relationships. Going off of a little bit of their management team, they don't have as many relationships, although they have recently done press, and that can lead into relationships, although that's still to be seen, 150K. And next we have product rollout. They've only been out for several months and they're already seeing profitability. So 350K. And add that all up, you arrive to a valuation of 1.6 million. Relatively simple qualitative analysis of what the valuation of the startup will be. Although, the more detailed you get, the stronger of evaluation you'll have evidence for and a rationale for. Some of the pros are, it's a very simple framework. You just take a look at each of the 5, and then you just put 500,000 towards it. You can even rank it from a scale of 1 to 10 and then divide up the 500,000 depending on how strong you think each section is. Some of the cons, you have a valuation cap of $2.5 million. That's not terrible because for the competition, we are only looking into seed and stage A companies. So oftentimes those companies aren't valued past 2.5 mil. Also, it depends highly, the quality of the valuation definitely depends on how much effort you're putting into the valuation. So how much analysis are you doing into each of the five in order to come to your final valuation. Right. Next, we have the cost to duplicate method. This one takes a little bit more effort, but the basics are you want to determine how much it would cost to start the same business from scratch. So you take a look at a SaaS company, just a general SaaS company. Let's say you have one technical founder. In order for the company to progress, generally you would want to hire 2 founding employees for technical to help develop the product. That would be 100K each for highly experienced software developers. Hosting software, generally 10K in a year. And if you're working from home, remote work from home, that's $0. Resource cost to write code is $0. Cost acquiring partnerships, 100K, advertising, 80K, total valuation, 400K. And this is the reasoning for this is basically because many startups have been created during COVID. So, oftentimes they're bootstrapping and they're just coming up with the resources themselves. So if you were to use the cost of duplicate method, it would arrive at a very or a lower valuation. So pros, you have a more detailed analysis of the company because you're looking into what they're spending their money on and how much you'd value each of the steps that they took. And you also often come to like a conservative estimate that can be a pro or con. Some of the cons are it's a retroactive lens on what the valuation of the company is. You're looking back at what they did and not to the future. And that can be something that you might want from companies that are high growth, high product market fit, or just low startup capital. Basically the outliers that might cause the framework to lose a little bit of its strength in providing you a strong valuation. Next, we have Porter's 5 forces. This is not a valuation tool. This is an analysis tool to help you, or to help guide you a little further on your valuations of these startups. So very simply, it's understanding what the competition is like in the industry surrounding a business. So the more competition, the less attractive the business is, and mainly because the competition will reduce profitability. So in Porter's 5 forces, you're looking at threat of new entrants, bargaining power of buyers, bargaining power of suppliers, and then the threat of substitute products. So the threat of new entrants is how low or how shallow is the moat surrounding the business. Take for instance, Uber. So Uber is an app, everybody knows Uber. It isn't terribly difficult to make an app. And looking back at when they were raising their seed round, it wouldn't have been terribly difficult to create another Uber. And in fact, Lyft is also a competitor. So that was created around the same time. So the threat of new entrants was likely high. Bargaining power of suppliers. Uber is unique in the fact that they don't have too many suppliers and the bargaining power is actually rather low because they generally use Google's API for the map. They develop all their software in-house. So the bargaining power of suppliers is relatively low. Bargaining power of buyers. So this might be rather high as well because you see demand during surge pricing in certain areas causing people to choose not to use Uber and instead use other forms of transportation. You also see the workers or the drivers of Uber. I think this is a relatively later thing from their seed stage, but you find that the workers are being paid less, and that also has a conflict in Uber's bottom line. And lastly, you have threat of substitute products. So similarly to the earlier thing, threat of substitute products is the Lyft issue, the Lyft dilemma. So whereas threat of new entrants is like how many, whether it's easy to make like the next Uber, threat of substitute products is probably more like the, or rather it's more like the existing like substitutes that like taxis. All right, next we have SWOT analysis. strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are internal to the company, whereas opportunities and threats are more external and environmental. So strengths are internal advantages that will help the business. Things such as how good is your management team, how strong is the product that you're developing. Weaknesses are internal shortcomings, tackling the same issues. Opportunities and threats are more external, depending on what the market is looking for. And yeah, so opportunities can be something like COVID created a lot of potential for technological tech companies. So Zoom saw COVID as an opportunity, whereas other companies might have seen COVID as a threat, such as restaurants. And so that's like a basic overview of what the SWOT analysis is. Just some final remarks on what valuation analysis is going to look like. When you want to talk about check size, generally varies by stage to stage. So if you find yourself evaluating a company at like $30 billion, something is wrong. Mainly because if you're looking at seed stage to round A stage companies, there's like a general idea of how much they're going to be valued at. So if you're looking to give a seed stage company like $250K to $2 million, that's generally around where you want to be targeting. Same goes for round A stage. You want to generally target around $2 million to $15 million. And that means their valuation, depending on what percentage you are planning on investing in, would be like however much that would be. Firms are generally created with a number of yearly investments and an average check size in mind. Startup valuations are, once again, just approximations, and there's no perfect way to value a business that has next to nothing. But these different models are good ways to help guide you in evaluating different startups and understanding if your investments are going to be profitable. And last but not least, I said I'd run through what all of the different mindset things to keep in your mind, where you have product market fit, management, market size, competitive edge, risk, differentiability, and scalability. All right. And lastly, we have our deliverables for the competition. Basically, we want a report and presentation. Investment thesis should be in both of these. And we also want the startup valuations and rationale. This is going to include evaluations. You can choose which valuations and analysis you want to do. But as I said before, the more detailed your analyses are, the better it will look in the eyes of people investing into your venture capital firm. So try to do as much as you can and make sure that these these investments that you're doing in these startups are smart investments. And last, actually, yeah, so this is a link to a Notion page that I created. Let's see if we can see this. All right. All right. Can somebody confirm that you can see the Notion page? All right, cool. All right. So this is just an example of just stuff to help you along your way to create the report and the presentation. So investment thesis generally has this format. This will be shared with all of you so you guys can go over all the information. So in the event that Rutgers Venture Partners was to make a investment thesis, just a one-line thing, I just said, Rutgers Venture Partners is launching a $10 million seed fund in New Brunswick, New Jersey to fund tri-state, New Jersey, Pennsylvania, Connecticut, SaaS, fintech, and edutech companies focused on improving student welfare, leveraging the partners' networks, resources, and experience on the Rutgers campus, basically just following this format. I also have portfolio companies here. Note that you guys don't have to make a Notion page. I just thought that this would be the best way to make it accessible to all of you. And I'll be updating this with examples on the presentation and the report. So clicking on Note you can take a look at what an example for a note would be. So I just took their elevator pitch, an app that automatically turns your notes into review quizzes, flashcards, assignments. I wrote down all of the different things, product market fit, management, market size, so on and so forth, SWOT analysis. And then I used the Berkus method evaluation and arrived at an investment for note. So that's generally it. That's everything that you guys need to do for in terms of qualitative analysis and what you need to do for valuation for the final deliverables. If there are any questions, please feel free to ask them, and I or someone else would be glad to answer them. So that's about it. All right. Stop sharing.
Thank you, Rahul. Yeah, maybe just a general question. Does anyone have any particular startups they're thinking about including? We can talk about those if you want, or if you have any specific questions. Or any questions on where to find startups.
Mm-hmm.
That's actually something I was worried about. Just fine, because I know in the original slides, hello, I'm Robert, by the way. In the original slides, there was that list of startups that you guys included. They were like all in the same graphic on the slide. But if there are like any particular resources you guys recommend for searching up new startups, or if you just find it by like general research or digging around on the internet, that kind of thing.
Yeah, of course. Actually, in the memo that I made for this, I have resources down at the bottom.
Oh,
so
great.
This is definitely like a good place to check out some various startups. I actually have something dedicated to that, startup list plus places to research. You can just take a look at all these different tools. I will say Crunchbase is probably your best friend with this. They are by far the most comprehensive database of startups. And yeah, they're just easy to navigate. They're just a good place in general. So yes, but you can take a look at this, and this will continuously be like updated over the course of the entire competition with various notes, various resources, so on and so forth. And you'll find Crunchbase's link on there.
Okay, great.
Yep.
And when is the quantitative meeting scheduled?
It's next week.
Next week. Okay.
Mm-hmm.
Great, because I'm used to looking at like SEC forms, like the 10Ks and everything, but I know this is a little bit more vague, let's say, in terms of financial information. So I appreciate it.
Yeah, it's definitely going to be a lot more qualitative than you'll find another type of like stock type thing to be. Yeah.
Okay. Thanks. Thanks again.
Yeah, no problem. Do we have any more questions? Any and all questions?
One thing I can add real quick. Well, so firstly, we're gonna give out suitable points. So if you want suitable points, don't leave yet until we're fully done. But one thing I'll add real quick is when you're looking for startups, remember that for this competition, we're looking for seed stage and Series A startups. So most of the big startups you hear about, like what did we do last time?
Like Airbnb.
Yeah, like Airbnb, DoorDash,
I mean, they've
Uber.
already.
A lot of them have already IPO'd, or they're Series C or Series B. So you want to look for early stage startups. So when you find a company, I would suggest the first thing you do is look up the valuation to make sure it's not already valued at like multiple billions of dollars. Because most of the startups you'll find are actually later stage. That's why they're better known. They come up more easily in the searching.
Yeah. I would definitely recommend if you have any questions with like whether your startup is seed or stage A, like send us an email or DM. Like I can put up our contact information right here. So yeah, you can find us at Rutgers VC, rutgersvcc.com. Actually, probably be easier to DM us. DM us. Is that how you say it? DM us on Instagram, or you can send us an email. I actually don't have the email here. Maybe I'll just type it in. It's rutgersvc@gmail.com, right?
rutgersvcc@gmail.com.
All right. All right. There
Yeah.
it is.
Yeah, you can also DM us on GroupMe.
Of course.
Yeah, does anyone have questions on the slide deck? You can feel free to look through that real quick and ask if you have any questions. Okay, yeah. If you have further questions, you can always contact us, as we were saying. For now, I guess that's it for today, right? We can share the suitable code.
Yeah. Let's go
Okay,
for it.
let's see. I'll stop recording for that.